You know the dream of buying a Toronto condo? That golden ticket to build real wealth? For a frightening number of people, that dream has become an absolute deadweight, dragging them into a financial nightmare. And I'm not being dramatic. What if I told you that some of these can't-miss investments are now selling at losses of over $250,000? This isn't a hypothetical. This is the reality in Toronto right now. There is a record-breaking flood of supply with tens of thousands of unsold condo units sitting on the market in the Greater Toronto and Hamilton area. People who bet their life savings on the city's eternally booming skyline are now staring at a catastrophic money pit. How did this happen? How did the dream curdle so quickly? We are going to expose the critical factors that turned Toronto's condo boom into a bust. We'll break down the numbers, look at the real-world consequences, and explain what this all means for anyone who owns or wants to own a piece of Toronto real estate market. The shattered dream. For years, the formula seemed almost foolproof. Buy a pre-construction condo, wait a few years while it's being built, and then either flip it for a huge profit or rent it out for a steady stream of passive income. The city was growing, demand felt endless, and the prices only ever went up. That was their dream. But for a massive number of investors, that dream is now completely shattered. The heart of the nightmare is a concept called negative cash flow, and it has become the norm, not the exception. Recent estimates suggest that over 80% of condo investors with mortgages in GTA are losing money every single month. The average monthly loss is staggering, with reports showing figures from nearly $600 to over $1,000 per unit for recent buyers. But this is just the tip of the iceberg. Think about that. Instead of your tenant paying down your mortgage, you are paying hundreds, sometimes thousands of dollars out of your own pocket, on top of rent you collect, just to keep the lights on. This is happening for two brutal reasons. First, carrying costs have exploded. Thanks to a series of aggressive interest rate hikes by the Bank of Canada, mortgage payments have skyrocketed. At the same time, a flood of new units hitting the market has cranked up the pressure on rents. The average rent for a one-bedroom condo in Toronto has fallen by 5% year over year. Investors are caught in a vice grip. Their costs are spiraling up while their revenue is falling. They can't raise rents to cover the difference because of rent control laws and fierce competition, and they can't sell without facing devastating losses. One downtown condo, for example, recently sold at a $260,000 loss, and that's before even factor in selling cost and taxes. They are trapped in a financial bleed out with no easy way out. The three pillars of the collapse. So how did we get here? How did a market that seemed untouchable just a few years ago fall apart so dramatically? It wasn't one single thing, but a perfect storm created by three interconnected factors. The first and most significant is the interest rate shockwave. For over a decade, investors were fueled by cheap money. But that party is over. The Bank of Canada, in its war against inflation, dramatically jacked up interest rates. And while the bank has paused its hikes and even made some cuts, the policy rate is still way higher than the rock bottom levels everyone got used to. This blew up the math for countless condo investors. Those with variable rate mortgages saw their monthly payments soar. And as fixed rate mortgages come up for renewal, homeowners are facing brutal payment shock, forced to sign on rates they never planned for. This is the main engine driving the surge in carrying costs that is crushing investors. The second pillar is the flood of empty towers. For years, the mantra was build, build, build. And they did, but demand was suddenly vanished. The result is a staggering level of oversupply. Right now, there are over 24,000 unsold new condo units across the Greater Toronto and Hamilton area. To put that in perspective, that's the highest number of completed and unsold units sitting on the market since 1993. The situation is even more dire in the pre-construction market. We now have an estimated 78 months of unbuilt, unsold inventory. A healthy, balanced market has about 10 to 12 months of supply. This is almost 7 times that level. Developers are so desperate, they are offering massive incentives like huge cashback credits and rental guarantees just to move units. But it's not working. New condo sales have plummeted, dropping 88% below the 10-year average in the first quarter of 2025. This is the lowest level of sales activity since 1995. When you have this much supply and this little demand, prices have nowhere to go but down. This leads us to the third and final pillar, the investor-driven house of cards. What made the Toronto condo market so fragile was its very foundation. By some estimates, the market was nearly 75% investor-driven. These weren't primarily people buying homes to live in. They were people buying a financial product. The whole game was built on one simple idea, that prices would keep rising forever, allowing them to sell to the next investor for a profit. This creates a deeply unstable market. When prices are climbing, everyone wants in. But the second the market stalls, that buying pressure disappears. There is no underlying demand from people who actually need a place to live to cushion the fall. It's a house of cards built on speculation, and the interest rate hikes were the gust of wind that blew it all down. Now, the same investors who drove prices up are the ones rushing for the exits, creating a wave of listings that is further saturating the market and pushing prices down even faster. The ripple effect. And this isn't just a problem for a few unlucky investors. This collapse is sending shock waves through Toronto's entire economy. The most immediate impact is on construction. With sales at a 30-year low and thousands of units sitting empty, developers are slamming on the brakes. Projects are being cancelled, put on hold, or converted to rentals at an alarming rate. Since the start of 2024, around 15 to 20 pre-sale projects have been shelved. Consequently, new construction starts have fallen off a cliff. In the first quarter of 2025, new condo construction starts dropped by 79% compared to the previous year, hitting the lowest level since 1996. This slowdown is having a direct impact on jobs. A recent report warned that a prolonged slowdown could put over 40,000 jobs in construction and related industries at risk. This is already being reflected in the city's unemployment rate, which has been climbing and sits well above the national average. And then there is a price plummet. While the average resale price for a condo across the GTA is down about 5 to 6% year over year, that number doesn't tell the whole story. In some buildings and for units bought at the 2022 peak, the drops are far more severe. TD Bank is forecasting that prices could fall by a total of 15 to 20% from their peak by the end of this year. We are already seeing the real world pain, with some sellers taking losses of over $300,000 on properties they bought just a few years ago. This erodes the equity of all homeowners, not just investors. And the real danger may still lie ahead, as more and more mortgages come up for renewal at these punishingly high rates. We could see a wave of forced sales from over-leveraged owners. If that happens, the current flood of inventory could become a tidal wave, potentially pushing prices down even further. Where do we go from here? So what's next? Is this the bottom, or is there more pain to come? The short-term outlook remains rocky. Most analysts agree that we'll likely see prices soften through the rest of 2025. The sheer volume of inventory needs to get absorbed, and with buyer confidence so shaken, the market is fragile. It is undeniably true that it is a buyer's market, where those with solid financing have more choice and negotiating power than they have had in over a decade. But here is the great irony of the situation. The solution of today's problem, slamming the brakes on construction, is planting the seeds for the next crisis. While we are drowning in a condo flood today, the pipeline of new housing is drying up. Forecasters are predicting that by 2026 and 2027, the number of new condos being completed will fall off the cliff. Meanwhile, the fundamental drivers of housing demand in Toronto, like immigration and population growth, are still strong for the long haul. So while the market is flooded with supply right now, we are simultaneously setting the stage for a severe housing shortage in just a few years. When demand eventually returns and meets a market with critically low inventory, it will inevitably put intense upward pressure on prices all over again. The Toronto condo dream has for now become a financial nightmare. It's a perfect storm of soaring interest rates, a massive oversupply of units that are impractically small, and a market that was dangerously addicted to speculation. The fallout is hitting not just the investors, but the entire city's economy. The next year will be critical. For buyers who have been waiting on the sidelines, this correction is creating opportunities that were unthinkable just a couple of years ago. For sellers and current owners, it's a time for tough decisions and strategic patience. But I really want to hear from you. What are you seeing out there? Are you an investor caught in this trap, or a buyer looking for an opportunity? Share your story and your questions in the comments below. I read every single one. If you got some value from this breakdown and want to stay ahead of the curve on the Canadian real estate market, do me a favor and hit that like button and subscribe to the channel. It really does help, and it allows me to keep bringing you these reports. The market is in turmoil, but it's always evolving. The dream may be a nightmare for some today, but the landscape of tomorrow is already taking shape. Thanks for watching.